All right, a new listing, and honestly, Ken, this seems like a pretty big milestone, I think, for a lot of these sort of middle market lenders, if you will, that, let's face it, 10 years ago, 15 years ago, wouldn't even be listed on a stock exchange.
Absolutely. Well, Romain, it's great to see you, and obviously, Alex, good to see you as well. It is, and I think it's representative of a continued trend toward, individual investors getting access to what historically has been more of an institutional asset class. And I think it speaks to the democratization of private credit and the opportunities that are being brought to individual investors to participate, obviously, in a very attractive area these days.
You talk about the democratization of private credit. We've seen this industry really expand, and you sort of allude to this idea that the traditional investors that were sort of the backbone of this industry a few years ago has now started to shift to more family offices, more individual investors. How much further do you think this is going to go in terms of attracting, a different class of investors than what we would normally think of associated with private capital?
I think it has a lot further to go. I mean, if you look at the development of the private credit asset class, and you're absolutely right, certainly over the last 10 years, the story has been the institutionalization of private credit. But I think as strong managers have demonstrated performance and track record and have shown their ability to deliver strong returns for investors, individual investors have taken notice and see this as an opportunity. So I think it is a long way to go. If you look at, our ability to generate attractive risk-adjusted returns, to generate those returns over, over an extended period of time through economic cycles, I think it presents tremendous growth opportunity for the industry. And I think that the better managers, the ones that have performed with institutional backing, I think will be the ones to be successful in the retail and the wealth channels.
Ken, I love that you mentioned economic downturn, looking at a day where the S&P is off by 2%. Some critics of private credit would say, hey, it's not really been tested in a deep, deep downturn. We don't know what the hidden risks are, et cetera. What do you say to that?
I would say that the largest scale managers, the firms that have performed now for well over a decade, have in many respects been tested. I mean, if you look at how private credit performed during COVID, during obviously a much more a rising inflationary environment, I think you've seen the top managers perform quite well. And certainly we as Churchill as a firm have been investing now for 18 years. So we invested through COVID, we invested through the rising rate environment and the current dynamics, and we invested back through the GFC as well. So I think private credit is here to stay, and I think that the performance of the largest managers that do have a 10, 15, 20-year track record, has borne that out. So I think for the large, more experienced managers, I think you can look back pretty far and see that performance.
So Ken, I have to wonder what the adoption you think is going to be for like the regular investor like me. Is it going to be a large part of my portfolio, a small sliver of my portfolio? How do you see that evolving?
It's interesting. I was talking to one of the senior folks at Bank of America the other day, and they were saying that their average client typically is invested, less than 5% in alternatives, and private credit only being a portion of that. So, I think that, there's an argument to be made that alternatives for an individual investor representing 10 to 20% of their portfolio is not unreasonable at all. And certainly private credit would have a place, in that portfolio. So I think, if you just look at the transition from less than 5% to as much as 10, 15, or even 20% of an individual portfolio, I think you've got a tremendous amount of runway there for the growth in private credit and for alternatives more broadly.
I'm curious, in the here and now, Ken, there has been some concerns here about the length of time that we've been seeing, the holding periods basically being extended much longer, particularly in some of the buyout funds, and even to a certain extent in some of the other funds as well here. Are you getting a lot of pressure or hearing about a lot of pressure coming from limited partners and other investors, curious about when they actually see a payoff?
Well, if you think about the nature of the alternative investors, the institutional investors that we serve, they are fundamentally less concerned about short-term liquidity. So for our large parent company, TIAA, or other investors like them, they're investing for the long term. They're investing to support the retirement needs of their members, their participants, whether it's an insurance company, a pension fund, or even a sovereign wealth fund. So I think that those institutional investors, are accustomed to less liquidity and are really looking at the longer term dynamics. So the short answer is, we have not seen any pressure at all in terms of holding periods or longer duration investment periods. In fact, if we can generate attractive returns over a longer period of time, that's exactly what our investors are looking for.